Is the market caught in a catch-22 with the Fed? I'm Lisa Bernhard with Reuters, and my guest today, Anna Rathbun of CBIZ Investment Advisory Services, does think that there's a catch-22 going on here. But first, Anna, let me ask you, stocks were up this morning. They reversed after Fed Chair Jerome Powell spoke today at the Central Bank Statistics Conference this morning, although he did not mention monetary policy. They went down. They're a bit choppy today. When they dipped, though, related, unrelated, what do you think?
What's interesting about today's market action is that the 10-year yield has been sliding throughout the day, but the market has also been sliding intraday. And usually in recent history, we've seen them move in an opposite direction. So this is definitely, they're unrelated to one another. And certainly the market action today seems to be unrelated from the Fed. There are, in my mind, these are short-term ups and downs. So if you think about the 7 to 8 days of gains in the last week or so, before that, we actually had broadly about 3 months of losses in the markets. And so in the short term, they were oversold. So it's understandable for the market to make a comeback. And then, of course, today, it's understandable that some traders may be taking some gains off the table in the middle of the day. Some people are saying that we've already reached new market bottom and that we may be in for a brand new bull market after the Fed starts to become more dovish. Well, I have a really hard time believing that. Today's action of a little bit of selling is a reminder that valuations still remain high and investors can become jittery when there are challenges still lying ahead.
Okay, so let's dive a little bit deeper into that, because as you touched on there, when we hear the Fed sound dovish, and Jerome Powell will speak again tomorrow, markets really respond to that. They rally around that. So that is going back to your catch-22 situation. Tell us how you think that then puts us in a catch-22.
Yeah, well, markets like it when there is weak economic news because it potentially means that the Fed is done raising rates or tightening liquidity conditions. The problem is that when yields fall and markets go up because everyone is happy that the Fed may be done raising rates, that actually loosens liquidity conditions. Yields fall and stocks go up, it means the liquidity is getting much better. That is the very opposite of what the Fed is trying to achieve, which is to tighten liquidity conditions. So actually, these market rejoicings actually increase the chance that the Fed will raise rates in December. So that is how this is a catch-22. In some ways, we have to tell the markets, don't react that way, then the Fed can accomplish what they're trying to achieve.
Let's talk about the American consumer, which we talk about a lot, but consumer spending powers 70% of this economy. And we are seeing a consumer that is still spending, despite hearing lots of news about how they may be running out of savings, despite hearing how they're racking up credit card debt at a time when interest rates are high, despite student loans coming due, all of that. Talk to us about why we are still seeing this spending, and is this ominous for a potential recession next year?
Well, American consumers are certainly an enigma, and consumers drive most of this economy. And the strength that we've seen unexpectedly this year for the American economy, you can thank that to yourself and your neighbors there. Americans spend. That is one thing that we can expect and anticipate the American consumers to do. We spend, and sometimes we spend more than we should. So what we're learning is that Americans would rather dip into their savings and borrow money from the future in order to spend today rather than to tighten their belts, right? So what we're seeing is that the savings rate, this is the latest GDP number, the savings rate actually started to fall and continued to fall throughout the year, which means that whatever the GDP contribution from consumption came from is actually on borrowed money. It wasn't on the money that people had on hand. The other thing is credit card balances are at trillions. It's at an all-time high. And the interest that balance is earning is higher than we've seen before. So this is over 20% of interest. So ominous, yes, because we are racking up debt. Ominous, yes, because our savings cushion is getting smaller and smaller. So there are challenges coming in 2024, especially as we're expected rates to stay higher for longer. If you haven't bought a car in the last 2 years and suddenly you need a car next year, you're going to be confronted with higher rates. It's going to impact your cash flow. So when your savings are low and you're paying high interest rate on your credit card, and suddenly you have to borrow money at a higher rate because you need a car or a house, this is all ominous. I think that's a good word, ominous, for 2024 for American consumers as well as the economy.